Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell so you get a notification when we release a new video. I'm sitting today with equity analyst Jana Van Rooyen. Jana's new to our team. Welcome, Jana.
Thank you, Robin. Thank you for having me.
She's very nervous today, so please treat her kindly. Jana, people will have seen that the CEO of Capitec Bank has been widely reported talking about the fact that impairments are up 80% and expressing a lot of concern around that. Can you, first of all, before we get into that detail from a South African perspective, explain to us what is an impairment?
So, Robin, an impairment is when an asset has a drastic reduction in the realizable value. In the banking sector, it's usually when the probability of a loan being repaid becomes minimal, and a bank will rather write that off. So a client can go to risk, and they can get the money back. So it's different in the case of Mondi, where their 3 operations in Russia is being impaired while they're busy with the process of selling these 3 operations due to the ongoing Russian-Ukrainian war. So they don't foresee that they will be able to recover the value of the assets, so they impair it and write it off. So it's a little bit different between the banking sector and your normal companies.
So, Jana, you've done a lot of work into the sort of consumer from that perspective. What did the CEO's comments sort of feed back into what you've already been reading elsewhere from the South African consumer's perspective?
Capitec is a very good example of what the average consumer, what their trend is at the moment, because their consumer is a third of the South African population.
Sure.
So we get a good understanding of what's happening with the consumer at the moment.
Yeah.
So there's definitely a lot of stress on the middle to lower income population, where they've seen an increase in the average annual debit order by 12%, more specifically home loans, vehicle finance and personal loans. And then of course your expenses. With inflation going up, we saw the March CPI coming out at 7.1% up year on year. It means your fuel and your food costs like that have gone up. So the consumer is really under pressure at the moment. We know that for the middle income, 70% of their disposable income is going towards debt.
Sure.
So with the interest rates that have been hiked for 9 consecutive times by the Reserve Bank since November 2021, our debt costs are the highest it's been since May 2009.
Okay.
So we see a lot of the clients defaulting on their loans, insufficient balances are increasing, and therefore that's why the impairment number went up.
Okay. So, I mean, obviously, I think people at home would identify with how things have gone up and how it's really moved through. But maybe bringing it back to a little bit closer to home from a portfolio management perspective. I know that you do work into that retail sector and look at some of the companies in that space. How do you, Harvard House, then sort of take a look with the data that we're now talking about in terms of portfolio construction? And feel free to use whatever examples you've kind of worked with previously to illustrate your point.
We've seen definitely a trend with Truworths over the festive season where their credit granting is, they've got a much higher data book. A lot of more customers are paying for their clothes and footwear on account.
Okay.
So they have much better growth over the festive season, where a company like Mr. Price, that's more stringent on their credit granting, didn't have such a great festive season turnover growth. For me, I think in the long run, knowing that the customers are under pressure, I'd rather think that a Mr. Price that has a lower debtor book is a far safer bet than Truworths that would have a much bigger debtor book. We know that Truworths 70% or up to 60-70% of their customers is on account.
Right.
So this feeds through to our supportive customer consumer theme, where our wallets are we're struggling, our wallets are getting smaller, so we'll start down trading, and companies like Mr. Price and Shoprite would be a far safer bet in the long term to invest in.
Okay. Well, it's really interesting to see how the data and the news flow feeds through to the analysis of companies and choices in portfolios. Jana, thanks so much. You did fantastically, by the way. Thank you for joining us. Don't forget to like and subscribe, and we'll see you next time. Bye-bye.